Okay, so in the final video that we're going to look at, what is the effect of a fall in an exchange rate. So this could be a fall in the exchange rate, it could be a depreciation, it could be a weakening of your currency, it could be a devaluation if you've got a fixed exchange rate system or a managed float as well. This question has come up many times, and it's really important that you get to grips with it, but also be prepared to go the other way. What would happen if there was a rise in the value of a currency? Okay, so remember, for any currency, if one is falling, then the other currency, the other country is having an appreciating currency. Okay, so be ready for both sides. So we'll go through this, and then there's one last slide, and I suggest that you take a good screenshot of it, and I've kept my ugly mug out of it so that you can take a good screenshot of a summary of all that I'm about to say. Okay, so let's go through this quite quickly, because you should know this quite well, I hope, by now. Firstly, if there's a fall in the exchange rate, then the price of exports is going to fall, so the volume is going to rise. The effect does depend on the PED of our exports in overseas markets, which we're going to come on to in the next slide. So starting in a simple way, we're going to say that basically, as there's a fall in the exchange rate, the volume of exports rise. The price of imports is going to rise, and so therefore the volume of imports is going to fall. So export volumes up, import volumes down, so therefore the effect of the value on those imports again depends on the PED, but basically with exports up, imports down, X minus M improves, and so you can say the balance of payments improves. Pretty standard and simple analysis, I hope, for you. It does, of course, depend, as I've just said, on the Marshall-Lerner condition. So this is what we started off with in the very first of these videos, that here we got a change in the exchange rate, so we always start off, keep it simple. If you need to in the exam to remind yourself, £1, $2, exporters, they need to earn £100, they sell for $200. Importers, they need to earn $200, so therefore they sell in the country, our country, at £100. Okay. If you have a fall in the pound, depreciation, weaker, falling, devaluation means the same. The price of our exports in foreign markets is going to go down, so we're going to sell more. It's as simple as that. The assumption is that when the pound has gone down like this, the value of the pound has gone down, we still want to earn £100. So an evaluation which you could use is that not all exporters are going to do that. Not all exporters are going to drop the dollar price. They might simply keep the dollar price the same at 200 and get £200 back. Okay, whatever they do, you're going to see that the value of exports is going to rise. Okay, but there it is for the imports. Price of imports goes up, and so you're going to sell less. If you were doing the opposite, the appreciation, you've just got to say that the price of exports is going to rise, so you sell less exports. Price of imports is going to fall, so you sell more imports. Okay, all right. So let's look though at the use of elasticities, because this is quite tricky, as I say. So the assumption is that it's not the sterling price when we're doing our exports that change. It's going to be the US price. So I'm going to use the US all the time here. So the UK firm wants to receive £100. The exchange rate is 1 to 2. So it's going to sell for $200. It's going to, again, wherever it sells, it's going to convert to £100. If the exchange rate falls to 1 to 1, our assumption, remember, is going to be that we will sell for $100. We're going to drop the American price. And then you're going to convert whatever you sell for $100 into £100, because that's the new exchange rate. So it doesn't matter what the dollar price is, you're still, for every one that you sell, you're still earning £100. Okay, so that's important to note. So how do you work out the value of exports? So the first part of the analysis was the volume of exports, but what's important is the value of our exports and the value of our imports. That's what the balance of payments is about. So if the exchange rate falls, price of exports fall, volume rises. If PED is elastic, that means that the volume is going to rise a lot when the price of my exports goes down. So therefore the value of exports is going to rise a lot with elastic. With inelastic PED, the volume is still going to rise, but it's going to rise by a much smaller amount when the price in America goes down. So the value will still rise, but by a small amount. So with elastic, price in America goes down, we sell loads more, we still convert, and we're getting £100 for every one that we're selling, and so we're getting a big increase in the value of exports. With inelastic, there's a small increase in the value of exports, but the value of exports will always rise. The extent of the rise depends on the PED. The higher the PED, the higher the value of exports is going to be. Okay, so that's quite important for what we come on to when we look at the Marshall-Lerner conditions. Let's have a look at imports. The assumption with imports, again, is that the sterling price would change. So the American who's selling their imports, they will change the price in the UK. And if the exchange rate falls, then the price of imports is going to rise. So the value, again, multiplies the volume by the price. So if the exchange rate falls, the price would rise of imports, so the volume is going to go down. Okay, and this is where it gets important that you can remember what happens to the total revenue when you have elastic and inelastic demand. Okay, so I'm going to explain it to you. If the exchange rate falls by, say, 10%, the price of imports will rise by 10%. If it's elastic PED, then the rise of 10% leads to a greater than proportionate fall in volume. Okay, so our import prices go up by, let's say, 10%, and because it's elastic, we're going to drop our demand for imports by 20-30%. That will mean that the value of imports will fall. Okay, that's important. If it's inelastic, the 10% fall leads to the import prices rising by 10%. The proportionate change in the volume is going to be much smaller now, and so the total value of imports is going to rise. So what that's saying is, if the exchange rate, say, goes down by 10% and prices of imports of a lot of our food goes up by 10%, we really can't cut our demand for food very much. And so even though the volume will go down, it might only go down by 1%, we're paying 10% more, we're cutting our quantity by 1%, so the value of imports will rise. Okay, so whereas with the exports, it always rose, with the imports, it depends on the elasticity. Okay, so that's important. So this slide here, I really would recommend that you take a picture of this one, because this summarizes what I've just said. Okay, if the PED for exports is elastic, the value rises a lot. If it's inelastic, the value rises, but only by a little. So they both rise. If it's PED for imports elastic, the value of imports is going to be lower. If it's inelastic, the value of imports is going to be higher. So elastic and inelastic for exports, both rising, but for imports, it depends on the PED whether it's going to rise or it's going to fall. So that's actually quite an important conclusion to reach. That leads you on to then the Marshall-Lerner conditions. So obviously, what you want for this fall in the pound to improve your balance of payments on the current account is that you want the value of exports to rise a lot. You want PED to be elastic. You want the PED for imports to be elastic because you want the value of imports to fall. So you want elastic PED in both sides of the market. And what Marshall and Lerner came up with is this idea that if a devaluation is going to improve the deficit, the sum of the elasticities of demand must exceed 1. Okay, that simply means take the PED of exports, add the PED of imports. If it's greater than 1, the balance of payments is going to improve when there's a fall in the value of the currency. Okay, and that's what you need to be able to quote in the exam. All right, let's evaluate that, and we're going to look at what possibly might happen in the real world here. So remember, when the currency depreciates, the price of exports fall, the price of imports rises. So the quantity of exports are going to rise, the quantity of imports is going to fall. Now, in the short run, they're not going to rise. The quantity is going to rise, but not much, because UK firms who are exporting into another country may not have spare capacity, particularly if they're close to full employment. So in the short run, it's likely to be inelastic, which means that the value of exports will go up, but only by a small amount. Imports, on the other hand, again in the short run, we're not going to be able to cut our demand for a lot of imports until UK industry comes in and starts to produce them. And so therefore, the elasticity is going to be low in the short run. Okay, so it's going to be inelastic in the short run. So if you remember the Marshall-Lerner conditions, the sum of the elasticities has to be greater than 1 for it to work. So in the short run, it's going to be less than 1 is the argument. And so you're going to get this J-curve effect, which simply means that in the short run, the balance of payments will worsen when you devalue or if there's a fall in the exchange rate because of balance of payments deficit. And this is what it's going to look like. So on this part here, we have X minus M. This is a surplus. Here's your deficit. And this is time. So the argument is, here is our lovely balance of payments, and it has gone into deficit. So as it goes into deficit, what might happen is that you reduce your currency. Either you intervene or the currency will automatically go downwards, if you remember from what we said before about demand and supply. But because the PEDs are inelastic, the first thing that's going to happen is that the deficit's going to worsen. Okay, so you're going to have the deficit, and whilst we expect it to turn up here, it won't, because in the short run the PEDs are inelastic, so they keep on going down and the deficit gets worse in the short run. Only in the long run does the PED become more elastic, and so therefore maybe now the Marshall-Lerner conditions are met, and so in the long run the sum of PEDs grows to greater than 1, they become more elastic, and so your balance of payments is going to start to improve again. And if you see this, that is like a J curve there. So here is the J, there's the J curve, that's the J curve effect. That the Marshall-Lerner might operate and be successful in the long run, but in the short run you're going to worsen your current account deficit. So the first important big point, if you're ever doing a question on a fall in the value of a pound, is going to be Marshall-Lerner and then the J-curve effect on the back of that. Okay. Second, what's the effect on output? Well, building on the effect on the X and M, aggregate demand, remember, comprises of CIG X minus M. If X minus M has improved, then the X minus M element is going to get larger, shifts the AD to the right, leading to higher real national output. So you're getting some economic growth with a fall in the currency. Valuation of that. On the supply side, of course, aggregate supply is determined by the quantity of the factors and the quality, the productivity of your factors. And so if you have got investment goods and they're being imported into your country, then the price of imports is going to go up with a fall in the pound. So you might find that there's less investment and a fall in aggregate supply, which offsets that higher real national output. That would be an evaluation point on the benefit of a rise in output. Effects on employment inflation. Well, let's have a look. Aggregate demand is shifting to the right. That means there's an increase in real national output, rise in employment, fall in unemployment. I think here you could then sneak in that you know that that's only a Keynesian view of the economy. In the neoclassical or classical view of the economy, you know that it's only the long-run aggregate supply curve that affects the level of unemployment, okay, and not the shift in the aggregate demand. And so that could be a nice little bit of evaluation on that one. Inflation, well, if aggregate demand shifts to the right, leads to APL going up, okay. Standard aggregate supply curve upward sloping, push your AD to the right, APL goes up. But in addition, remember, the fall in the exchange rate means that import prices are more expensive, and therefore that's imported raw materials, and that leads to cost push inflation. Okay, so again, this is another reason why inflation is likely to go up with a fall in the exchange rate. Right? What about productivity? This is, again, one of the more difficult ones for you to get, but see if you can manage it. What it says is this, that if you have a weak currency, okay, over time it's going to affect the level of productivity and it's going to affect it adversely. Okay, it's going to be lower. And the reason for that is this, that if companies or firms know the exchange rate is going to fall, if say inflation is high, that's what PPP theory says, then they don't have any incentive to resist demands for wages or simply to become more productive, because they know that if they're not productive, the prices in our country are going to go up faster than other countries, because our unit costs are basically going to be going up. And so they know that the exchange rate is going to fall in order to let them off the hook all the time. So it doesn't force the companies to become more productive. Better way to think about it, if that's sort of tricky to get, is the other way. There were countries like Germany that used their strong currency. The Deutschmark, before it joined the euro, was very strong, and they used that to force their companies to become more productive. They were basically saying to their companies, we're not going to allow the Deutschmark to fall, so therefore, if you want to compete internationally, you've got to become productive. And so a fall in a pound really doesn't give that incentive for productivity, and so there's that impact that productivity is likely to be lower. Okay, all right. The last one, apart from small ones, is on the foreign direct investment, and you've got to think of it in two ways. Basically, the amount that a company in an international market is going to invest in another country, that's direct investment, buying another firm, buying machinery, setting up a company, is going to depend on the current value of the exchange rate. So let's say you've got an American company, they want to buy a British company, and the price is £10 million. So if the exchange rate is £1, $2, they've got to spend 20 million. Okay, turn their 20 million into 10 million. Okay, if then the exchange rate fell to 1 to 1, right, fall in the value of the pound, it means that they only have to spend their 10 million in order to buy UK companies. So the current value is, if the value of the pound goes down, it's cheaper for companies overseas to buy British assets, and so they're going to come in and there's going to be more inward investment. Okay. However, let's have a look at the future value. Let's say the Americans have come in and they bought up our company. What will happen if the future value is going to fall? And the argument is they're buying an asset in the UK and it's falling in value. So they spent their 20 million at, let's say, 1 to 2. They bought a 10 million pound asset in the UK, but then they find in a year's time the pound has fallen to 1 to 1. So they take their 10 million pound asset and they turn it back into dollars and they earn $10 million. But they started with 20 million. And so therefore, if you think the value of a currency is going to go down, it's going to reduce inward investment. So if it does go down, it's going to encourage it. But if it keeps on going down, then it's going to discourage inward investment. Really difficult argument to get over, but worth trying to do that. Okay. All right. What about other effects? Well, living standards, they're likely to rise, mainly because if the imported goods become cheaper, then you're going to find that that's going to improve. Okay. Big one though is this, that if a government of a country has borrowed in international markets to fund infrastructure, then the debt is going to be dominated in dollars. So a lot of countries like Sri Lanka at the moment have got a lot of dollar debt. And if the currency goes down in value, they need to find more of their currency to buy those dollars, to get those dollars. Okay, and so therefore that's going to be difficult for them. Okay, all right. So what you need, good summary table, and I'm not in this one, so once I've gone through this, I take a screenshot. This is a summary of everything that I've just said. Okay, Fall in the exchange rate, the benefits. Growth is going to rise because X minus M rises, assuming Marshall-Lerner. Employment rises, unemployment falls. Trade deficit improves, assuming Marshall-Lerner conditions are going to apply. PDs of exports plus imports greater than 1. And FDI can be attracted in the short run, but it might be put off if the exchange rate is expected to keep on falling. Okay. What are the drawbacks? Inflation. Prices of imports higher leads to inflation. Living standards are going to fall. Imports are more expensive. Investment might fall. The imported machinery could be more expensive. Productivity might fall because you don't need to become productive. You're going to be let off the hook with a falling exchange rate all the time. And the cost of paying that dollar-denominated debt is going to rise. So if there's a fall in the pound, you've got some benefits, you've got some drawbacks. Both are going to be reversed if you have a rise in the exchange rate. The benefits of strong exchange rates: living standards are going to rise, inflation is going to fall, investment will rise because the value of your imports, machinery is going to fall, productivity might rise. You've got to be productive now to survive, and it's slightly easier to pay your dollar-denominated debt. Growth is going to be lower though because X minus M is going to fall. Okay. Employment is going to fall, unemployment is going to rise, trade deficits is going to worsen, and FDI could possibly also reduce if there's a rise in the exchange rate, because it's going to cost them more of their currency to buy some of the assets in this country. So it's a really important table for you to take a snapshot of and make sure you can go through that for a developing or a developed country as well. So hopefully that's of help to you.